Welcome back students and scholars. In this video we are moving into ASC 230 practice, multiple choice questions and short answers. This is where we test whether the cash flow classification map is truly clear. You will answer 8 MCQs and 4 short answer questions covering operating, investing and financing classifications, direct and indirect method logic, non-cash disclosures and presentation traps. The goal is not just to choose an option. The goal is to explain why the option is correct. In accounting exams and professional reviews, a lucky guess may pass one question, but reasoning passes the topic. So today, think like a preparer, an examiner, and a reviewer at the same time. Here is the practice learning path. First, we will work through 8 multiple choice questions. Second, after each question, we will review the answer logic and understand why each option is correct or incorrect. Third, we will handle 4 short answer questions where you must classify, explain and apply ASC 230 rules in your own words. Fourth, we will close with a final rule audit that you can apply to any cash flow scenario. Try to answer before moving mentally to the answer slide. Active recall is where learning becomes stronger. Watching an answer without thinking is like reviewing a bank reconciliation without checking the bank statement. It looks productive, but it may not catch anything. Before the questions begin, use this 4-step approach. First, read the facts carefully and identify what actually happened. Second, ask whether cash moved. This is the gatekeeper question in ASC 230. If no cash moved, the transaction does not belong in the statement body. Third, choose the correct category: operating, investing, financing, or separate non-cash disclosure. Fourth, explain the reason. A strong answer should include both the label and the logic. Do not classify based only on keywords. For example, the word debt may appear in both interest paid and principal repayment, but those two items do not land in the same cash flow category. MCQ 1 tests the cash focus of ASC 230. The question is, ASC 230 mainly reports which movement? Your options are A. All accrual revenues and expenses recognized during the period. B. Cash and cash equivalent inflows and outflows during the period. C. All owner equity changes during the period. And D. All fair value changes in assets and liabilities. Take a moment and choose the single best answer. Ask yourself, is ASC 230 trying to report accrual performance, equity movement, fair value changes, or actual cash movement? Lock your answer before the explanation. The correct answer is B. Cash and cash equivalent flows. ASC 230 focuses on cash receipts, cash payments, the net change in cash and cash equivalents, and the beginning and ending cash balances. Option A is incorrect because accrual revenues and expenses are mainly income statement items, not the main focus of the cash flow statement. Option C is incorrect because owner equity changes are reported through equity-related statements or disclosures, although some equity transactions may create financing cash flows. Option D is incorrect because fair value changes can be non-cash. The key memory line is simple. ASC 230 follows actual cash movement, not every accounting measurement movement. MCQ 2 tests non-cash activity. The question is, equipment is acquired through a finance lease and no cash is paid at inception. How is this transaction reported under ASC 230? Your options are A. Operating cash outflow in the operating section. B. Investing cash outflow in the investing section. C. Financing cash inflow in the financing section. And D. Separate non-cash disclosure outside the statement body. Think carefully here. The equipment was acquired, so something economically important happened. But did cash actually move at inception? Choose your answer now. The correct answer is D. Separate non-cash disclosure outside the statement body. If no cash moves at inception, the transaction is not placed in operating, investing, or financing cash flow totals. Option A is wrong because no operating cash was paid. Option B is wrong because an investing cash outflow requires actual cash paid for the asset, and that did not happen at lease inception. Option C is wrong because the entity did not receive cash from a lender or investor. Option D is correct because a finance lease with no cash paid at inception is a significant non-cash investing and financing activity. It affects the balance sheet and matters to users, but it stays outside the cash flow statement body. Non-cash is not invisible, it is separately disclosed. MCQ3 tests equipment purchase classification. The question is, cash paid to purchase equipment for use in operations is normally classified as what? Your options are A. Investing activity, B. Operating activity, C. Financing activity, and D. Separate non-cash disclosure. The key phrase is cash paid, so this transaction belongs somewhere in the statement body. Now ask, is equipment purchase part of routine operating cash payments, capital investment, or financing with owners and creditors? Think through the nature of the asset before choosing. The correct answer is A. Investing activity. Cash paid to acquire property, plant and equipment is a classic investing cash outflow under ASC 230 because it relates to acquiring long-term productive assets. Option B is wrong because operating activities include cash flows from producing and delivering goods and services, such as payments to suppliers or employees, not capital expenditure for equipment. Option C is wrong because financing activities involve owners and creditors, such as issuing shares, borrowing money, or repaying debt. Option D is wrong because cash was actually paid. The transaction belongs in the statement body, and the correct body section is investing activities. MCQ 4 tests a very common classification trap: interest paid. The question is, under ASC 230, cash paid for interest is generally classified as what? Your options are A. Investing activity, B. Financing activity, C. Operating activity, and D. Separate non-cash disclosure. This is where students often think interest relates to debt, so maybe financing. But ASC 230 does not classify everything connected to debt in the same place. Choose carefully. Is this the cost of borrowing, or is it repayment of the borrowed principal? The correct answer is C. Operating activity. Under ASC 230, cash paid for interest is generally classified as an operating cash outflow. Option A is wrong because interest paid is not a cash flow from buying or selling long-term assets or investments. Option B is wrong because financing classification applies to borrowing proceeds and repayment of debt principal, not generally to interest paid. Option D is wrong because cash was actually paid, so this is not a non-cash disclosure item. The key distinction is powerful. Interest paid is generally operating, debt principal repayment is financing. If you remember that split, you avoid one of the most common ASC 230 errors. MCQ 5 now tests the other side of that same trap: debt principal. The question is, cash paid to repay the principal amount of long-term debt is normally classified as what? Your options are A. Operating activity, B. Financing activity, C. Investing activity, and D. Restricted cash activity. The phrase principal amount is the signal. We are not talking about interest expense now. We are talking about returning borrowed money to creditors. Choose the best answer. The correct answer is B. Financing activity. Repayment of debt principal is a financing cash outflow because the entity is returning borrowed funds to creditors. Option A is incorrect because repaying principal is not part of determining net income and is not a normal operating cash payment. Option C is incorrect because investing activities relate to long-term assets, loans made to others, and investment securities, not repayment of the entity's own borrowing. Option D is incorrect because restricted cash is a presentation and reconciliation issue, not a fourth activity category. The memory line is this: borrowing and principal repayment sit in financing, interest paid is generally operating. MCQ 6 tests the direct method. The question is, which statement best describes the direct method of presenting operating activities? Your options are A. It presents major classes of operating cash receipts and payments directly. B. It begins with net income and adjusts it for non-cash items and working capital changes. C. It reports only investing activities in a detailed schedule. And D. It removes all reconciliation support from the financial statements. Focus on what the direct method actually shows to the reader. Does it start with net income or does it show gross cash classes directly? The correct answer is A. The direct method presents major classes of gross operating cash receipts and gross operating cash payments such as cash collected from customers, cash paid to suppliers, cash paid for operating expenses, cash paid for interest, and cash paid for income taxes. Option B describes the indirect method, not the direct method. Option C is wrong because direct versus indirect relates to the operating section, not investing activities. Option D is wrong because direct method presentation does not automatically eliminate reconciliation support. For-profit entities, ASC 230 may still require a reconciliation of net income to net cash from operating activities. The direct method is transparent, but it is not a free pass to skip support. MCQ 7 tests indirect method working capital logic. The question is, inventory increased and accounts payable decreased during the year. Under the indirect method, both of these working capital changes generally do what? Your options are A. Decrease operating cash flow from operations, B. Increase operating cash flow from operations, C. Affect only investing cash flow, and D. Are ignored as non-cash items. Think through the cash story. If inventory increased, did cash get tied up? If accounts payable decreased, did cash go out to suppliers? Choose your answer after tracing the cash effect. The correct answer is A. Both decrease operating cash flow from operations. An increase in inventory means the entity used cash to build stock beyond what was expensed. That is deducted from net income. A decrease in accounts payable means the entity paid suppliers more than it incurred on credit during the period. That is also deducted. Option B is wrong because neither change is an add-back. Option C is wrong because operating working capital changes affect the operating section under the indirect method, not investing activities. Option D is wrong because working capital changes are not ignored. They are timing differences between accrual income and cash flow, and the indirect method exists largely to reconcile those timing differences. Working capital is where cash timing reveals itself. MCQ 8 tests a presentation trap. The question is, which of the following items should not be displayed in the financial statements under ASC 230? Your options are A. Cash paid for interest, disclosed separately. B. Cash paid for income taxes, disclosed separately. C. Non-cash investing and financing activities schedule. And D. Cash flow per share of common stock. Read that wording carefully. Three options relate to required or acceptable disclosures. One is specifically prohibited. Choose the item that ASC 230 does not allow to be displayed in the financial statements. The correct answer is D. Cash flow per share. ASC 230 prohibits reporting cash flow per share of common stock in the financial statements. Option A is wrong because cash paid for interest is disclosed separately under ASC 230. Option B is wrong because cash paid for income taxes is also disclosed separately. Option C is wrong because significant non-cash investing and financing activities must be disclosed separately, either in a schedule or in the notes. Option D is the trap because students often confuse it with earnings per share. EPS may be required under ASC 260, but cash flow per share is not a GAAP financial statement display item. ASC 230 is very clear here. Do not display it. Now we move to short answer 1. You need to classify 6 items as operating, investing, financing, or separate non-cash disclosure. The items are sale of inventory, purchase of equipment, issue of shares, debt principal repayment, interest paid, and a finance lease with no cash at inception. Write your answers before moving to the model answer. This is not only a labeling exercise. For each item, ask whether cash moved, who the counterparty is, and what the economic purpose is. If you can classify these 6 correctly, you already control many of the most frequently tested ASC 230 basics. Here is the model answer for short answer 1. Sale of inventory is operating because cash received from customers is part of the entity's principal revenue generating activities. Interest paid is generally operating under ASC 230. Purchase of equipment is investing because it is cash paid to acquire a long-term productive asset. Issue of shares is financing because cash comes from owners. Debt principal repayment is financing because the entity is returning borrowed funds to creditors. The finance lease with no cash at inception is separate non-cash disclosure because no cash moved when the asset and lease obligation were recognized. Notice how the answer is not based on account names only. It is based on cash movement and economic purpose. Short answer 2 asks you to explain direct versus indirect method. In your own words, answer 3 parts. First, what does the direct method show in the operating activities section and how is it different from the income statement? Second, what does the indirect method start with and what types of adjustments are made? Third, should both methods produce the same final cash flow from operating activities or CFO? Think through the mechanics and the result. This is a good place to practice an exam-style written answer. Short, clear, and logical. Do not write a textbook paragraph, write like a professional explaining the method to a reviewer. Here is the model answer. The direct method presents major classes of gross operating cash receipts and gross operating cash payments. Examples include cash collected from customers, cash paid to suppliers, and cash paid for operating expenses. It shows actual cash flows rather than accrual income statement amounts. The indirect method starts with net income and adjusts for non-cash charges such as depreciation and amortization. Removes items like gains or losses that belong elsewhere and adjusts for working capital changes such as receivables, inventory, and payables. Both methods must produce the same CFO because they are different presentations of the same operating cash flows. The method changes the route, not the destination. Short answer 3 is about a mixed transaction. A company acquires equipment for a total cost of $100,000. It pays $40,000 in cash and issues a $60,000 note payable to the seller for the remainder. No other cash changes hands. Question 1. How should the $40,000 cash portion be reported in the statement of cash flows and in which section? Question 2. How should the $60,000 note payable portion be reported and can the full $100,000 appear in the statement body? Take a moment and split the transaction before answering. Mixed transactions are where ASC 230 tests discipline. The model answer is report only the cash portion in the statement body. The $40,000 paid in cash is an investing cash outflow because it is cash paid to acquire equipment. The $60,000 note payable portion is a non-cash financing element of the acquisition and is disclosed separately as a significant non-cash investing and financing activity. The full $100,000 must never be reported as a cash outflow in the statement body because only $40,000 of cash actually moved. Reporting the full amount would overstate investing cash outflows by $60,000. The rule is clean. Cash portion in the body, non-cash portion in the separate disclosure. Do not blend them into one inflated cash line. Short answer 4 asks about gross versus net reporting. First, why does ASC 230 generally require gross reporting of cash receipts and payments rather than presenting a single net number? Second, what key conditions must be met for net reporting to be permitted? Name at least 3. Third, why is net reporting considered the narrow exception, not the default? Think from the user's perspective. Would a single net number show the scale of cash activity, or could it hide important inflows and outflows? Build your answer around transparency, turnover, size, and maturity. Here is the model answer. ASC 230 emphasizes gross reporting because it gives users a clearer view of the volume, scale, and nature of cash receipts and payments. Netting can hide large inflows and large outflows behind a small net number. Net reporting is allowed only in limited circumstances, generally involving quick turnover, large amounts, and short maturities, often 3 months or less from the acquisition date or origination point. These conditions suggest that gross presentation may be less meaningful or too burdensome for high frequency short term movements. But the default remains gross reporting. Net reporting is the narrow exception, not the starting assumption. If you cannot justify netting, report gross. Before closing, let us apply the final rule audit. First, did cash move? If no cash changed hands, keep the transaction out of the statement body and consider non-cash disclosure. Second, which bucket applies? Operating is for principal revenue activities and related operating cash flows. Investing is for long-term assets and investments. Financing is for owners and creditors. Third, which method applies? Direct method shows cash receipts and payments. Indirect method starts with net income and adjusts to CFO. Fourth, is disclosure needed? Check for interest paid, income taxes paid, significant non-cash investing and financing activities, and the cash flow per share prohibition. This 4-question audit is more useful than memorizing answer patterns. Accounting is not a lottery ticket. The logic must stand. Let us close this ASC 230 practice session. The first memory anchor is cash movement first. If no cash moved, the transaction is excluded from the statement body and may require separate disclosure. Second, classification follows: operating, investing, or financing, based on the nature and purpose of the cash flow. Third, method logic matters. Direct method shows gross cash classes. Indirect method reconciles net income to CFO, and both should produce the same operating cash flow result. Fourth, disclosure traps matter. Interest paid, income taxes paid, non-cash activity schedules, and cash flow per share rules are all testable. If this practice session helped you, please like it, share it with your colleagues, subscribe to Commerce Regiment, and support the channel so we can keep building serious free education. In the next video, we will revise ASC 230 and connect it to IAS 7 and the SAP reporting bridge.